Hi, everyone. We're going to give it about 30 seconds or so to let people join, and then we will begin formally. Stay tuned. All right. Good afternoon, everyone, and thank you for tuning in today. I'm Jane Leung, a member of the CFA Society of San Francisco's Board of Directors, and it is my pleasure to welcome you to our event this afternoon called Bonds Are Back with JoAnne Bianco of BondBloxx. Just a quick note before we start, you're going to be muted for the event, so we encourage you to just type the questions you have within the Q&A box. We're going to monitor those questions closely and endeavor, hopefully, to be able to answer as many as we can. But I know that JoAnne's got a fun-filled, jam-packed session today. As you have heard before, we will be recording this event as well, too, and we'll share the replay afterwards. So now it's my pleasure to introduce and turn it to JoAnne Bianco, partner and client portfolio manager at BondBloxx. I'm really excited to hear what you have to say today, JoAnne.
Thank you. Thank you so much, Jane, for moderating this conversation with us today. We're very excited to be here.
Yeah, no, it's great. And I mean, I think it's a really interesting time in the markets and in just the world today with everything going on, the pandemic kind of waning, but we still have a war on. We have a lot of, macroeconomic uncertainty. And, everyone's hawkishly watching or feverishly watching the interest rates, inflation, and all the, economic indicators out there. We titled the webinar today, Bonds Are Back. And I think that's a cool title. And I would love, though, if you could just really start by telling us why you believe this is actually true.
Okay, great. So if bonds are back, I guess the first question is, where are they back from? They're back from near zero interest rates for US Treasuries, which is where they were before the Fed started its rate campaign over a year ago now. They've raised the Fed funds rate a total of 9 times, or 475 basis points, and there's probably another rate hike to go at the May meeting. So where does that leave the fixed income markets now? In a much higher yielding environment. The income is back in fixed income, and with still resilient fundamentals for corporate bond issuers. All this leading to our opinion that investors should increase their allocation to fixed income this year. Of course, investors will still have to contend with continued market volatility, like we've already witnessed in the first quarter of 2023, with economic headwinds and fallout from the banking system turmoil, and also the increasing possibility of a recession in the second half of the year. Risks also remain that credit markets could experience downside volatility from here. Yet we still think that the current higher yields available in fixed income, in most cases representing an over doubling of yields since the beginning of last year, are better entry points for investors to increase their allocation to fixed income.
Right. And you just mentioned that we were happy to see this rebound in the financial markets during the first quarter of 2023. I think it would, if you could go into just more detail around that, that would be, I think, really helpful for our listeners.
Sure. If we could see the next slide first. Okay, so yeah, absolutely. But first, I really wanted to give this quick reminder of what an outlier year 2022 was in terms of financial market losses. And so to quickly explain this slide, the x-axis shows the yearly total return for the 10-year Treasury, while the y-axis shows the total return for the S&P 500. And I actually have 100 years of history here. So not only does 2022 stand virtually alone in the lower left quadrant with no other years around it, only 3 other years were even in this quadrant over the past century, meaning that it's very rare that equities and bonds go down together. So on the lower right quadrant, you can see that in many previous downturns in equities, fixed income provided positive diversification benefits. But this wasn't the case in 2022, when both bonds and equities went down together in performance, and there was virtually nowhere to hide except in cash. Okay, so if we could move to the next slide. So fast forward to the end of the first quarter of 2023, and we're back to the upper right quadrant from that scatter plot on the previous page. On this slide, you can see the rebound. It's been broad-based across fixed income and equity sectors that's been experienced. And the blue bars showing the total return losses last year, just as a reminder for all of you, while the green bars show the rebound across fixed income and the S&P 500 during the first quarter of 2023. These first quarter returns don't do justice in terms of capturing the interquarter volatility that was experienced in fixed income, especially in the month of March, especially in US Treasuries in the aftermath of the Silicon Valley Bank and Signature Bank failures. And so the volatility experienced in Treasuries was near the highest level for this asset class since the TARP bailout of 2008.
And that's, like you mentioned, there's just a lot of volatility. And I think that's what is making, so many investors out there very, very nervous. I mean, certainly, I think when we talked about 2022 being an outlier and where there was no place to hide because both equities and fixed income were in a bad place, I think that it can cause a lot of panic and concern for investors because they don't really know how to put this into context of what they've seen historically. And so I appreciate these slides because they help kind of show really what I think everybody's feeling, which is there's a lot of things that are going on, and they're in fact quite scary in terms of how to think about them. And so from that, I would ask JoAnne, what's your outlook from here? How do you think this rebound is going to continue? Are you expecting more choppier waters ahead? Are we looking at another 2022 at some point? What do you think?
Well, my quick answer is a bit of both. Both the higher fixed income yields provide cushion against spread widening, but choppier waters ahead for sure. Another year like 2022, not possible, I think, in terms of the fact that you just couldn't see Treasury rates go up another 475 basis points from here. So you just wouldn't see that kind of same negative return for Treasuries. And so in terms of credit products like investment grade and high yield, despite the potential for economic weakening or spread widening, we think we could still see a better year in those asset classes as well. And also if the economy does shift down or weakens to the extent that it results in a shift downward in interest rates, this would actually translate into positive total return performance for US Treasuries, especially on the longer end of the curve. So the reverse of last year. But in any case, just as I said before, it's not a stretch in our opinion to say that the markets will remain volatile. And regarding US economic conditions and the potential of a recession in the second half of the year, we agree with the assessment that the length and the severity of the banking system turmoil will play a meaningful role in what happens to the US economy from here. But this is the same economy that has proven quite resilient so far, with corporate earnings that have been holding up, a strong consumer, low unemployment. So the major danger here, in our opinion, would be a full-blown credit crunch. And this would be one of the main market risks that we need to keep monitoring. On the inflation front, yesterday's CPI release came in around expected, showing inflation trends continuing to moderate. However, the trends are not moderating enough to dissuade the Fed from raising rates again next month at the May meeting. But we're in the camp that we think that it's likely that this could be their last rate hike before pausing, especially now that the banking system turmoil factors into this, because it would be harder for them to continue raising rates.
Yeah, I mean, I would agree. I think that certainly no one expected the banking. I mean, certainly I came from SBB, so I know a thing or two about what people were expecting, and it was obviously something that was a bit of a shock to the system. And I do think that that is still playing out, as you've kind of implied. And I think hopefully that is, I'm sure, is being watched by the the Fed and other lawmakers and people that are close to this, because I do think that it's all sort of interconnected, right? And you just have to be very careful about the kind of actions that are taken. But I appreciate that you mentioned that the CPI is starting to moderate, and hopefully eventually will be at the levels where they do not need to continue to raise interest rates. But thank you for your perspective on that. I do think that a lot of people are watching what's going to happen with rates. Is it almost over? Are we improving? And it sounds like we generally are moving in the right direction. So hopefully the banking contagion will not spread too much more, but at the same time, it seems that it's not quite over yet, and we need to shore things up. So we'll keep watching that, as you say. Why don't we now take the opportunity to kind of turn our attention into a little bit more detailed into the current environment, your outlook, and then really do a deeper dive into asset classes. Would love to learn more about your ideas for current opportunities in specific fixed income classes. I think the audience would love to hear what you're thinking in terms of specific areas. So if we could, why don't we start with the US high yield market, if that's all right?
Okay, and if we wanted to move to the next slide. Okay, so high yield got off to a really strong start in the first quarter, especially the month of January. Broad high yield indices were up close to 4%. That's good. That's really good for one quarter. And triple Cs were up over 6% for the month. High yield has experienced more volatility since then, with a down month in February and certainly a bit of a roller coaster month experienced during March, as risk assets sold off in conjunction with all the banking turmoil. But it still ended up being a very good quarter and a very good start to the year for high yield. The other story, when you delve deeper into quarter one performance, is the still elevated dispersion of returns that are evident both by credit quality and by industry sector. In the credit rating categories, as I said just earlier, triple Cs were the performance leader not only in January but for the quarter, and the higher quality double B sector lagged for the quarter. In industry sectors, performance dispersion was continued to be high as well, and there were 5 industries that performed better than the broad high yield index return that you can see here. But only 3 months into the year, and we're already seeing a significant performance difference between the best and the worst performing industries in high yield. A 340 basis points differential between the best performing consumer cyclical and the worst performing TMT, we think is meaningful. And we think this elevated dispersion will continue. And so what that all means to us is that it creates opportunities for investors when they pick their spots in high yield.
No, that's great, JoAnne. Thank you. But I'm curious, how healthy is the high yield market from a fundamentals perspective? I mean, it's I do think that given what we've just talked about the environment and defaults of banks, defaults of, just lots of uncertainty in the markets, that, investors are kind of wondering, how risky is risky, and what are the fundamentals really looking like in high yield? And maybe you could share a little bit about how the fundamentals compare to time periods before the previous down cycles, and maybe, sorry, it's a long question, but what do you expect in the upcoming quarters in terms of fundamental health of this area?
Yeah. Those are all really good questions, and I'm so glad I get to answer those questions because we have a lot to say about this. The really good news is that high yield fundamentals entered 2023 from a position of relative strength. This is really one of the key points that we probably want you to take away today. And the word that most accurately describes current high yield fundamentals, in my mind, is resilient. So in terms of some of the specific fundamental indicators, balance sheets remain strong with leverage stats still around pre-pandemic lows. Interest coverage measures are at multi-year highs. The credit quality breakdown in high yield remains better than prior to previous down cycles. Right now, we have close to 50% of the high yield market is rated BB, which is the highest rating category in the asset class. And there is a lower percentage of CCCs than we've seen historically, around 10% currently. In terms of other areas of fundamental strength, debt maturities for high yield issuers remain manageable for the next 2 years at least, giving companies runway to navigate their liquidity in the current environment. Kind of what we've been told is that anytime there's like an open window to issue debt, the investment banks are encouraging companies to come to market so that you can push out that maturity schedule even further. And that benefits the high yield market. And then finally,
go ahead.
Default expectations for 2023. It's the defaults will probably increase this year with more economic weakness, but it's not like we're expecting a default rate that would end up above the long-term average of defaults, which is around 4%. And that's something that, like, in the context of the current market environment, the high yield market could handle that. It's not like we're projecting that there's going to be a significant spike in high yield defaults this year. So, all in all, it's a really good fundamental starting point in high yield. And then your other question about like how this compares to previous cycles. I mean, I was in high yield for many years, and I would say that like what I'm seeing now compared to what I've seen in the past is I'm not seeing the same level of excess building in either certain industries or in the market in general in terms of like leverage buyout activity, all that kind of stuff. For the last 5 years, it's been primarily refinancing that's been done in high yield as opposed to, growth CapEx or, a lot of other things that are something that could be hurtful over the longer term for high yield credit quality. So this is probably one of the main reasons why high yield spreads have held up so well.
Right. And so, I mean, it sounds like, your perception of the current relative value and attractiveness, it sounds like it's pretty attractive at this time. Would that be a fair sort of?
I think it is. I think there's this common perception that, or what we hear is that like at current spread levels, high yield bonds aren't pricing in bigger problems for the US economy. And that makes some investors want to wait before they increase their allocation to high yield. But when we look at current spread levels, we're less surprised about where they are. What they're in line with is the long-term averages that have been experienced during previous Fed rate hiking cycles. Because when does the Fed hike? They hike in a strong economic environment to slow the economy down, to reduce inflation. So, that's where we stand in terms of like the attractiveness of the high yield market, that you don't necessarily need to time this to get spreads at their widest level or try to invest when you're at a market bottom. It's a difficult thing to do, so instead, our view is that investors should opportunistically invest in high yield at today's higher yield levels. The yield levels are more than double where they started 2022, and they provide cushion for spread widening.
Yeah, no, and I think that's great that I know you all have been looking at this for a very long time, and this space, and so that's not surprising to you that it's acting as if it should. I think that's good from an investor point of view if they're starting to look into this asset class. It's
Oh, I
interesting.
have another point to make there
Oh,
too,
yeah.
actually, is, and at these elevated yield levels, we've done work and we estimate that credit spreads could widen around 200 basis points from here,
Mhm.
even in the context of defaults rising to around their long-term average, and the asset class would still generate a positive return in 2023. And so that demonstrates the power of the income component in high yield at these higher yield levels.
Yeah, no,
Of
that's a great
course,
point.
investors should still pick their spots and the specific risks that they're comfortable with. So we're not, out here advocating that people just, load the boat on triple C's or even broad market exposure if that's something that doesn't fit their risk profile. But there's definitely areas in high yield that seem real attractive.
Yeah, no, and I think that that's a good point to make, JoAnne. I'm sure that, everyone has to really take into their own, personal and respective risk tolerances and how they're thinking about it before. But at the same time, if they are interested in this space, it sounds like there are certainly some attractive areas within high yield at this point, which is great. And I was thinking that it's like historically the perception, you always hear people talk about junk bonds, and I mean, and I think you still hear that as how people describe high yield bonds, and their perception about risks of default and loss and just all the things that have happened over the course of history with high yield bonds and junk bonds. But do you think that's an accurate way to look at this asset class?
Well, it's a reasonable question and assumption, especially if you're picking individual high yield bonds, especially at the lower end of the credit quality spectrum, with the liquidity and the idiosyncratic risks associated with individual high yield issuers. But investing in a diversified high yield portfolio is a different story, in my opinion. The annual total returns generated by high yield indices have been overwhelmingly positive throughout their history. There's only been 5 down years over the past 26, and only 2 of those down years were a negative return greater than 5%. One of those being the great financial crisis in 2008, and then also last year, 2022. But last year, high yield was actually a relative outperformer compared to all other fixed income asset classes and all other U.S. equity sectors. It had a negative return, but a much less negative return. And if you look at longer time horizons, high yield has outperformed all other sectors in fixed income. Yes, higher risk, but yes, higher return ability, certainly. And then a point that I think that people don't necessarily consider is that the volatility of high yield returns are significantly lower than the volatility experienced by equities. And this makes sense due to high yield significant coupon income component, which cushion price declines, and equities don't have the same level of cushion with their dividends, which are just a smaller component. And the final point I think I want to make here is that there's never been 2 negative performance years in a row for high yield, and we don't think 2023 will break that streak. Again, starting with that much higher yields to absorb potential spread widening.
Yeah, it's interesting. I mean, I guess if the pandemic and the last few years have taught us nothing else, it's to expect the unexpected. But I love that you said that there haven't been 2 negative performance, years, because I had not known that. That's pretty amazing for this asset class. And so, JoAnne, what are you telling your clients in terms of specific opportunities within high yield?
Yeah, once again, it's always about picking your spots in high yield. And I can say from experience, as all of my best years as a former high yield portfolio manager were when I got the industry sector and the credit quality calls right. So towards that end, in terms of specific ideas that we have right now, I mean, basically you take a step back and we favor industries that are able to generate healthy cash flows now, instead of those industries that are dependent upon high future growth rates. So specifically, we like the energy industry. It's got strong fundamentals still, higher average credit quality than most of the other industry sectors in high yield, with over 60% of its exposure rated BB. And it also has many rising star candidates still in the high yield index, which could provide performance potential. Let's see, we also like the resilience that we see in the consumer sectors, with the still strong and generally employed consumer. So both the consumer non-cyclical and the consumer cyclical industries we like. And then finally, in industries, we like the resilience that we see in earnings and the balance sheet strength that we've seen in the core industrial industry. So that's another one of our favorites. In terms of credit rating categories, right now we prefer the single B category, not necessarily the BB category. We like the yield advantage that the single Bs provide over not only the broad high yield index, but also over BBs, and their lower interest rate risk with their shorter duration versus both BBs and BBs. And finally, the single B index is very well diversified across industry groups and corporate issuers. So we like that as well about it.
Great. So before we move on, though, I have one last question, because, we've been talking about high yield, and it sounds like a great place to be potentially, if you have the risk tolerance. Sounds like there's specific, areas that are, very interesting to look at. But regardless of there must be some, risk and danger to the outlook or for high yield in general. So could you just tell us and take us through a little bit about what happens if it all goes to wherever, right?
Right. Yeah. Well, obviously, like the biggest risk would be right now, a foreseen risk or something that we could possibly know would be a full-blown credit crunch, because that would hurt all risk assets, including high yield.
Mhm.
And high yield, there's definitely certainly been instances in the past where unforeseen stresses to specific industries become pervasive enough that they reprice all of high yield. I mean, that's definitely happened before. Telecom, energy, or a hard landing economically would, it would have to hurt the high yield market. It would have to widen spreads, because it would just be something that would, these companies with less cushion than investment grade companies in terms of their balance sheet strength would just get hurt easier.
Yeah, no, that's really helpful, JoAnne. Thank you. Why don't we move along to a different asset class, and kind of talk a little bit about investment grade corporates. I think this asset class seemed to have experienced one of the worst years in its history in 2022. And maybe we could start out by talking about how they've been performing in the first quarter of 2023.
Yep. Well, they've experienced a very nice rebound in the first quarter, and that's, they're definitely helped by the long duration nature of this asset class. So basically, precisely what hurt it so much last year is helping it this year. It was definitely not like a spread widening story last year. Everything that happened in terms of the total return, the negative total returns in investment grade, were because of the long duration nature of those assets. And AAAs, which fell the most last year, they have almost a 10-year duration, recovered the most in the first quarter. And then that was followed in performance, as you can see here, by AAs and then BBBs.
And maybe just like we were talking about in the high yield section in the discussion, how do the fundamentals and the fundamental picture, how does that look for investment grade corporates?
Also resilient, the main word there again.
Yep.
Also starting from a position of strength at the beginning of this year, solid earnings, low average leverage, just like high yield is around pre-pandemic levels. interest coverage averaging close to 13 times. That's a near record high. Another point to make here is that most BBB rated companies appear to be very comfortably rated in the BBB category, meaning that it doesn't appear that we're about to see the next huge wave of fallen angels down to high yield. And that's really an important distinction, because that's certainly something that has affected investment grade corporates significantly in the past. So all of these factors are very supportive of the fundamental strength of the investment grade corporate bond market.
Okay, great. And then how about, current relative value, attractiveness of this asset class?
Right. Well, so here again, yields more than double where they started 2022. And that translates into a 13-year high in yield. So the last time we saw yields this high for investment grade corporates was in the aftermath of the great financial crisis. So with the Fed most likely near the end of their rate hiking cycle, there'll be, less impact on IG from rising rates. So the focus now can be more on credit fundamentals for investment grade and not on the gyrations for the asset class that happened from interest rates last year.
Okay, so the credit fundamentals. Where then are the specific opportunities within this space then?
I think we're just like a fan in general of investment grade corporates because of their resilient fundamentals and their higher credit rating profiles to be able to withstand an economic downturn, and their yields around 13-year highs. But we're also constructive on BBB corporates themselves. They have less of the investment grade banking or financial component, which has experienced the most spread widening in IG this year and could continue to underperform. And then once again, just like I just said earlier, the majority of the companies in the BBB category seem to be expected to remain at BBB ratings. So that's supportive of BBBs. Okay,
no, that's really helpful. And then where are the risks? So it sounds like generally, this is a good space to be with respect to fixed income for the reasons you described. But what's the downside that people need to be aware of when investing in this area?
Well, the main one would be, continued or more severe banking system contagion or turmoil, turning into a full-blown crisis. And also, I guess the potential for downgrades or further spread widening of financials themselves would be another risk. That would impact the entire asset class.
Yeah, no, I think it's interesting because a lot of what we're talking about today is again, it leads to the volatility, uncertainty, and things that may be almost like black swan events that could affect everything, which, as we know, because what we've seen, I guess that can still happen. It may not be a huge probability, but it could still happen. And so I guess investors do need to be aware of that, that scenario.
That's so true, Jane.
Okay, well, that's great, JoAnne. Why don't we talk about U.S. Treasuries? Let's maybe start by recapping the performance last year, which apparently was one of the worst years in history. You talk a little bit about that, and then discuss maybe how they've performed across the yield curve over the first quarter of this year.
Okay. Yeah, sure. Longer duration treasuries experienced one of their worst years on record last year. So, for example, a 10-year duration U.S. Treasury index was down over 17% last year, while a 20-year duration index was down almost twice that, over 30%. It's so unusual for treasuries to be down this much. But these negative returns just show how low rates were before the Fed started hiking. So there was virtually no coupon cushion to offset the price declines. So on the other end of the spectrum, 6-month duration treasuries managed to earn a modest positive return last year, one of the only positive returns in fixed income, besides leveraged loans, but they're floating rate. So fast forward to the results for the first quarter of 2023, and due to shift downward in the yield curve, except for the shortest tenures. And as you can see here on this slide, the longer dated portion of the US Treasury curve outperformed once again.
Mhm, 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 mhm. And then can we talk a little bit about the yield curve and how that changed and sort of what is the implication of all of that?
Okay. Mhm. Yeah, I mean, there was near record volatility in interest rates during the first quarter,
Mhm.
driven by the uncertainty about what the Fed is going to do. Will they hike more? Will they pause? Will they cut rates? Also, a lot of uncertainty about what's going to happen in the economy. First, there was talk of a soft landing, then no landing, then a hard landing. And I mean, it's going to continue to change from here, I'm sure. And then there was also uncertainty about whether inflation will actually get back down to the Fed's 2% target level, when that would happen. And then finally, throw in banking system turmoil and the risk of a banking system contagion. And it all adds up to very volatile conditions for the US Treasury market. In terms of the yield curve, it remained inverted. It's still inverted now, but it moved to its highest level of inversion in 40 years between the 2s, 10s curves by early March. There was a 110 basis point differential between the 2s and 10s. And then the yield curve proceeded to massively steepen in just a couple of weeks, a really large move for such a short period of time. But it still remains inverted around 50-ish basis points, I believe. And the implications of this, the front end remains elevated due to Fed policy, while the long end is lower due to fears of a recession, falling inflation, banking system risks, any one of these factors or all of them.
Right. Okay. So then, given what you've shared about this, what do you think? Where are those opportunities then within U.S. Treasuries?
Well, the higher rates in general across the yield curve and treasuries has definitely increased the attractiveness of this as an asset class. And investors have options all along the curve, considering whatever their investment goals are, their risk appetite, their tolerance. And, treasuries will perform differently under different scenarios. And what should investors think about this? I mean, for investors that are uncertain about what's ahead, they could consider the shortest duration treasuries, and they have compelling yields in excess of 4.5% still, and low price risk, no credit risk. A great place to ride out the market volatility or economic uncertainty, and also just the higher yielding alternative for investing your cash than we've seen in a really long time. And then for investors who believe that, the Fed may be nearing the end of the rate hiking cycle, or a slowing economy is coming, they could consider the middle part of the treasury curve, and maybe there capture total return potential. Is, a cooling economy and lower rates usually results in positive total returns for this part of the curve. And then finally, not to forget the long end, for investors who anticipate a hard landing, that probably the most performance potential they could get would be out of the longest dated treasuries as a potential total return opportunity. So because bonds further out in the curve, definitely have performed well in terms of hard landing scenarios, especially as the expectations for inflation decline.
Okay, wow, that's great. Thank you so much for sharing all of this, JoAnne. This is
Sure,
really,
my
really been
pleasure.
very interesting. And before we move on to questions, I did want to, are there any kind of final summary points you wanted to make around the things that you shared with us today? Any highlights or things you've missed to share that you want to share before we get into questions?
Yeah, I guess it's just that we do think that there are opportunities in fixed income that there haven't been in a few years. There's opportunities in credit and in treasuries, and we wouldn't necessarily think it's the best idea necessarily to wait for a market bottom, but we're at better valuation levels, yields that could provide cushion against spread widening, or just higher yields in treasuries in general. So it's just something that we think that there are opportunities in this environment to use fixed income in your portfolios or increase your allocation and enhance your performance.
Great. Okay. No, thank you very much. Very, very interesting. And I know that the audience has been engaged because we have a number of questions for you. So that's
Okay.
great. And so we'll spend the next, few minutes or so going through some of those questions. The first one I'd like to ask JoAnne is about, you had mentioned previously in the high yield section that there hadn't been 2 years in a row of negative returns for high yield. Could you share what the time frame is that you're using on that one?
26 years.
A long time. That's a long.
Yeah, so
Okay.
almost the whole history.
Almost the whole history. Okay, perfect. Great. The next one is, what percentage of outstanding investment grade debt is rated in the triple B area? And how does that compare to historical averages?
So it is around, I would say that triple Bs are around half of the market in investment grade, around 50%. So, and that's higher than it used to be. It's for a number of factors. First of all, I think that companies are more comfortable, and the marketplace is certainly more comfortable with companies having triple B profiles, and that being the best way to finance themselves, especially when we had lower rates and they were able to put in a lot of funding on their balance sheet at low rates. So it's a bigger part of the universe than it had been historically.
Okay, great. No, thank you. And which, in your opinion, is the more likely scenario, that the Fed pauses and holds for an extended period, or they're forced to cut rates soon? That actually came from a question from before we
Okay.
had the webinar, so during the registration period. So.
Well, we think the first scenario, that the Fed pauses and holds for an extended period of time, is ideally what the Fed would like to do. And, the clear message by the Fed is that they intend to raise rates and keep them there until inflation is back down to their 2% target level. The real wild card to this scenario is, once again, about the banking system. If the turmoil were to accelerate and deepen, this could change our view, and this could cause the Fed to cut rates sooner.
Mm-hmm. Yeah, no, that makes a lot of sense. And what's your outlook on structured products? Mortgage-backed securities, asset-backed securities, those types.
Well, it's the same thing there, where you're at yield levels that you haven't seen, so they're more attractive from that perspective. So the asset quality seems to be holding up as well in those areas as well.
Mm-hmm. Mm-hmm. Yeah, makes sense. And when is it most effective to use? I get this question all the time: individual bonds versus bond funds, because obviously BondBloxx, you have funds, but then clearly people can also choose sometimes to hold long bonds. So how do you think about that, and how do you advise clients?
Okay, so could you repeat that question? So
Yeah.
individual bonds, like in treasuries, you mean, or in
Yeah,
corporate?
so the question was it was very more general. So if you have a different view on specific assets classes within the bond arena, that would be helpful too.
Okay, well, I would definitely think that for corporates, investment grade corporates and high yield, a diversified portfolio approach would probably be the better idea there, where you're getting the benefit of diversification and you have less idiosyncratic risk, and you probably have better liquidity in terms of what you're buying as an individual. And in treasuries, there's arguments for both. I mean, if you're comfortable, going and buying treasuries and rolling them yourselves, you could do that, but you could also take a portfolio or ETF or fund approach where that's done for you, and then you get the return without that having to do that yourself.
Yeah. No, that makes sense. And do you have a view around preferred stocks at this time? That's another question that just came up.
I really don't necessarily. I'm sorry to say.
Okay.
I could get back to whoever asks that question with an answer on something like that, but
Sure, no problem. Yeah, we actually have it all sort of linked in. We can certainly
okay.
answer directly later. So no problem. Um, Question, it says, if we have entered a longer term trend in yield to higher from lower for the first time in 30 years,
Right.
so the 10-year treasury, I think, based on the person who's asked research, how do you think that will affect the banking system?
Yeah, I mean, there's effects on the banking system there because, you basically the heart of this, a heart of some of the issues that the banks are dealing with now is, the spread, the difference between deposit rates and market-based rates. Depositors have woken up to higher yield levels, and we're in a much more mobile banking world where it's easier than ever to move your money. So it's reasonable to assume that consumers and corporations will continue to seek out higher yielding alternatives. And less in deposits for banks means less money available for them to hand out loans, which then translates into, negative effects for the economy. So, and I think it's probably most reasonable to assume that the biggest impact near term would be on small to mid-sized businesses if there is a tightening in lending standards.
Yeah, I think, yeah, that makes sense. And last question for you, JoAnne. So we've talked about there being, a pretty attractive risk return profile set here across the various asset classes that we've been talking about. I mean, at least in certain places. How long do you think that's going to continue?
Well, our thoughts today are really reflect our outlook for 2023 for fixed income. I've never really projected out my views longer than a year. I think that it's just better to do things at a year at a time. Hey, if you can get a year right, but all the caveats that I mentioned in terms of some of the risks involved could have us refine our views as the year goes on. But for now, I mean, we just like the higher income available in fixed income across a wide variety of sectors, especially the ones that we highlighted today, being high yield, investment grade, and US Treasuries. So that's where we are.
Great. Okay, well, I think that's pretty much it in terms of we got through all the questions. So thank you so much, JoAnne and the BondBloxx team for presenting today and showing us some really great data. I know we got a lot of participants and interest and questions. So I appreciate the time, and thank you everyone for joining us today. We'll be sending out a recording of the presentation, and I look forward to seeing you at the next event.
Thank you. And on behalf of myself and all of my colleagues at BondBloxx, I'd like to thank Jane as well for moderating this and for all her questions in our conversation today. So thank you.
Thank you. All right. Take care, everyone. Have a great day.